Well, hello, everyone. Thanks for joining us today for our webinar. Today, we're going to hear from Chad Staskal, our founder of Eagle Wealth, and City National Rochdale Portfolio Manager, Robert Meckstroth. We're looking forward to hearing Robert's insights and analysis of the impact of current events on the economy and our financial markets. Before I turn the call over, note that all the participant lines are muted during the presentation, and you're welcome to submit any questions during the presentation. To do so, use the little Q&A box at the bottom of the screen. At the end of the presentation, we'll collect all the questions and answer them. A recording of this webinar will be available on our website along with the slides next Monday. So with that, I will turn the call over to Chad.
All right, good afternoon, everybody. This is a great day for us to be doing a webinar. I'm sure Robert probably maybe fielded a few calls with the market volatility between up a bunch yesterday, down a bunch today. And, you know, there's just so much noise out there right now. And we decided to put this presentation on just knowing that we're getting just a few calls, just a few questions and saying, man, I don't feel like I've ever felt like this before. It's easy to kind of forget, you know, just how it wasn't that long ago we were dealing with the pandemic. And then prior to that, it was, you know, when interest rates started doing the similar situation back in 2018. So just this uncertainty, this feeling of just like what is going on. We also like to just kind of take a step back and really kind of dive back into, you know, what's the purpose of, you know, what we're doing with you and the ability to try and help you put a little bit of a purpose to your plan. So we're going to focus quite a bit on some different topics today. We're going to hit on inflation. We're going to hit on the war in Ukraine. We're going to hit on interest rates and really this market volatility. Robert and I have conversations every single day talking about these things. And we like to really have an opportunity to share with you kind of a large group as opposed to the one-on-one because there is just so much going on. So with that, I'm going to turn this over to Robert. I'll jump in on a few slides to kind of talk a little bit more of the bigger planning and kind of how we look at the investments. And from there, you know, we'll go into a question and answer at the very end. So we are going to leave some time for questions and answers. And I promise if we don't get to your questions, we will be following up with a phone call or an email to get back to you. So don't worry about that. We're going to do our best to kind of stay within this 1 hour. And we are leaving some time for those questions. So this is a great time just to, your question is probably thought of by somebody else, so don't be shy. So in the bottom of your screen, you're going to have a chat button, and that chat is where you can ask questions. All right, I'm going to turn it over to Robert. Thank you very much.
Well, thanks so much, Chad, and thanks everybody for taking time out of your day to join us this afternoon. Like you said, Chad, what a fitting day to have this. I mean, you're putting me to work right after this crazy market close today, and I mean, what better day to talk about what is driving the volatile markets right now? And secondly, you know, how do you invest at a time like this? Because it hasn't been easy. One of the fascinating things that we've really never seen before is that when markets are volatile like this, usually it's the conservative investments that are doing the best, that are holding up the best. But you could have sold out of every one of your stocks at the end of last year, put it into the safest municipal bonds, and you'd still be down 10% this year. In fact, many conservative investors are down sometimes even more than more aggressive stock investors, depending on your security selection. This is not a normal market. So I think to start, you know, many of you who work with us and have seen us talk before have seen the speedometers page. If you haven't, as a refresher, these are forward-looking 6 to 9 month indicators. And this is the updated May version of the 20 indicators we think are most predictive for where the US market and economy may be going. And what you see here is a lot of yellow indicators, more yellows than we've had in a while, but also a lot of green indicators. I think the green ones sometimes are more surprising than the yellows, given what's playing out in the media day in and day out. And I think Chad hit on the key themes, and we'll talk about all of them, but you can see the inflation, energy cost indicators here obviously are some of the most negative. And this is probably one of the most, probably the thing that's causing some of the Fed activity, some of the interest rate movement more than anything else. And you know, inflation was an issue before Russia invaded Ukraine and now is a bigger issue. So we'll talk a lot about what Russia's invasion means for the broad markets, the US markets, because unfortunately, it's not really something that's going to fix itself anytime soon. We're looking at a long, drawn out conflict there. And the big news yesterday was just continued Fed interest rate hikes that, are really pretty much expected at this point. But the difference between Fed expectations now and what they were at the start of the year is staggering. And that is probably the thing driving markets more than anything else, the abrupt change in interest rates. And we know when interest rates go up, that negatively affects conservative investors, but it also can negatively affect the highest growth speculative investors at the same time. So what's fascinating about this market is the dramatic rise in interest rates has not only hit conservative assets, but it's hit the most aggressive stocks at the same time. And we'll have more to talk about with that. So all things considered, you see inflation, you see interest rates as negatives. We won't talk too much about the political environment, but obviously both domestically and geopolitically, it's not necessarily a stable political environment right now. That just adds some fuel to the fire. But it's not all doom and gloom. And I think that, hopefully is one of your takeaways from this call today, is that there is positive data out there, even though it doesn't seem like it sometimes. And the Fed talked about this yesterday when they raised interest rates, the double rate hike yesterday. One of the comments was, the economy is still fundamentally strong. And some people were surprised by that, because if you saw economic reports from earlier this week, you saw the US economy contracted in the first quarter. So many people are calling for recession now this year, and we are not. And you can hear it, the Fed is not calling for recession. And what the Fed is doing is saying inflation is by far the number one issue right now. We need to fight it aggressively, but we're comfortable raising rates faster because the housing market is still very strong. The labor market is incredibly strong at a time like this. We have record amount of job openings out there, and we also have unemployment claims that are almost at the lowest levels we've ever seen. There's lots of talk about the Great Resignation and people who have left the workforce, but there actually are fewer people than any time in a long time filing for unemployment claims. And what it means is if you want a job in this market, you probably have one. So kind of moving forward, I love this chart because it kind of shows the potential outcomes for the US economy through the end of this year and also through 2023, 2024, because everyone's commentary right now is, when is the US going to hit a recession and what does that mean? So you see, this is, in our opinion, a couple of potential paths. And notice that you have normal growth, slow growth, mild recession. And even in the mild recession scenario, look at how we don't see that turning like a negative scenario until 2023 or sometime into 2023, even in kind of the worst case scenario. And I think that surprises some people who think, we might be in a recession right now. I don't think there's any data to suggest that. But I also don't think that this normal growth scenario is a likely one. I think we're headed for a slow growth or mild recession type scenario, which isn't necessarily bad news. A slow growing economy is not a bad thing. That can be a very good thing when expectations are for a recession. And even a mild recession, stock prices typically fall 10 to 20% in a mild recession. That's about what we're down now in the overall US market. So I do think we'll get data over the course of the year to see how the economy is responding to higher interest rates. But I don't think major recession is something that's in the cards, and you can kind of see it in this page. So what are the year-end projections that we have? So when you look at GDP growth, we're still forecasting fairly solid economic growth this year. And I think that's huge. If you think the economy is going to grow at 3% this year, which we still do, despite the first quarter negative growth number we got, and you still think corporate profit growth is going to be 5 to 10%, that's not necessarily a recipe for the stock market to decline another 15% by year end. In fact, if these numbers hold true, if I had to project, I'd project that stocks are at a higher level by year end than they're at now, given that corporate profit growth remains positive, which we see it happening. The same thing goes with inflation. And we'll spend some time today really breaking down inflation, because inflation is not going anywhere. you see year-end inflation forecast is still 5 to 6% as far as the CNR view. That's down a little bit from the 8% we have now, but it's still significantly higher than the Fed's target of 2%. So when you look at how you position a portfolio right now, you have to think, how do you hedge against inflation? And then how do you prepare for the higher interest rates that are coming? So we know the Fed is likely to get interest rates back up to, call it 2.5% by year end. And we've already seen the longer term interest rates move up a lot. So again, when you look at something like the 30-year mortgage, the 30-year mortgage is completely repriced from where it was 3-4 months ago. And, we're at, call it 5.5% maybe now on the 30-year mortgage. But remember, long-term interest rates are not controlled by the Fed. The market anticipation and market forces control longer-term interest rates. So even though we know the Fed is going to raise interest rates maybe 6-7 more times before year end, that doesn't necessarily mean that long-term interest rates are going to go up a lot more than they're at now. That's a very key point when you look at, are we at the bottom of this correction or do we have more damage to go? I would argue that as far as long-term interest rates moves go, we're not likely to see much of a change. And the 10-year forecast notes this. We're at right around 3% on the 10-year now, and we're not calling for it to be much, much higher. I'll get into what that means for the investments in a few minutes. But first off, let's just hit on the Ukraine situation. So the first most important point is there are direct effects and indirect effects from the crisis. Inflation is one of the biggest direct effects, but look at our forecast for inflation effect from Ukraine, the world, the US, and the Eurozone. You see the impact of this in the US is lower than both the Eurozone and the rest of the world. Points for the US there. And then potential economic damage from the war. Notice the US here. Basically, the US and China, the most limited from damage economically. And it comes down to trade, where the US really isn't trading much with Russia and Ukraine. So it doesn't have as big of an impact. But look at France and Germany right now. France and Germany are the ones taking the biggest hit the longer this conflict goes on. And I would be avoiding Europe as much as you can when it comes to investments right now. And you'll see that in the portfolios that we manage. We've got nothing invested in Europe, and we have portfolios heavily weighted to domestic investments in the US. And this kind of sheds some light on that. When you look at Russia, they're the third largest oil producer, the second largest gas producer in the world. 48% of Russian oil is going to Europe. 72% of Russian gas is going to Europe. Europe's talking about an oil embargo against Russian oil, but not until the end of the year. It's really hard to replace that Russian energy. It's really hard to replace it without costs going up. So you think we have gas price issues here in the US, just rent a car and drive across Europe and note how much it costs to fill it up, and you'll see what higher gas prices are there. But food is also a big issue. Russia and Ukraine make up 25% of the global grains market, a lot of fertilizer coming out of Ukraine. If that food is not hitting global markets, it doesn't matter that the US produces enough food here for our domestic needs. These are global markets and prices go up. But look at some of the countries that really rely on European and or Russian and Ukrainian grain. Europe, Egypt, Turkey, even countries like Bangladesh and China get some significant food from the region. And that just means potential humanitarian crisis in some of these developing countries. And again, shortages and higher costs. So again, when you talk about inflation going up, this is one of the biggest changes is you have to project much higher food and energy inflation, which we'll talk about in a minute. Then the supply chain issues. So you can see we have these issues that are causing a lot of volatility. It's not just China with supply chain issues. Here's Russia and Ukraine, raw materials that are a big part of the global supply. Look at something like neon. Almost 70% of the world's neon comes from the region. Palladium, titanium, aluminum, platinum, nickel. I mean, even, these ones that are only 10, 20% of the global market, it does damage. It causes prices to go up. And we already had these supply chain issues even before Russia invaded Ukraine. And then throw in what's going on with China. China locking down Shanghai, trying to continue to keep COVID cases close to zero, which is really almost an impossible task. So supply chain stress with China is going to last longer. So all of this points to higher inflation for a longer period of time. And again, we'll get into how you invest based on that scenario. But one final point, again, I just want to hammer home that the U.S. does not trade much with Russia. Look at trade last year. We only exported $13 billion worth of stuff to Russia versus $104 billion worth of stuff to, from the EU to Russia. And again, you just see this, when you project European economic growth across the board. Look back in 2014. What happened in 2014 when we had sanctions against Russia for the annexation of Crimea? Look at the damage it did to German and French trade back then. Talking about $23 billion hit to German trade in 2014. And those sanctions were nothing compared to what we're seeing now. But back in 2014, US actually picked up some trade. And we're seeing some of that again right now, because again, the US is a net exporter of things like natural gas. So when the energy crisis heats up across the board, prices go up, but the US is in just so much better shape than countries like Germany or Japan or India that don't have a domestic energy industry. So even though the US consumer is hurt by higher energy prices, very important to note that our energy businesses are much more profitable and actually get to pick up on exports. So that brings us into inflation. So again, the Ukraine situation has made inflation worse. I mean, it's almost hard to fathom these numbers because we haven't seen them in decades, that we have 8.5% year-over-year inflation. That's just a shocking number. And I'll kind of break down where that inflation's coming from, because some areas are actually starting to see some prices to improve. Used cars actually dropped for the first time in months over the last quarter. But you can see our forecast is that inflation is going to start trending down. You have two things that are going to bring inflation down a little bit. One is the actions of the Fed. When you raise interest rates, you start cooling down the economy. But the second part is these calculations are year-over-year changes in prices. So what's going to happen in the second half of this year? We're going to be comparing end of 2021 prices with end of 2022 prices. That comparison is going to be a lot tougher to see big jumps in price values, because right now we're still comparing early 2021 prices with early 2022 prices. So those prices early in 2021 were much lower than at the end of the year. So those will all help bring inflation down, but make no mistake, inflation is going to remain high even by year end. That 5.5% number is still no joke. And you really have to take it seriously. It really makes conservative investments still tough to justify at a 5.5% inflation level. So what's driving inflation? You can kind of compare the start of 2021 when inflation was just taking off to where we are now. Some of the big jump is energy prices, like we talked about, but also food. So food and energy are kind of the biggest surges in prices to really get that 8.6% number up there to that high we haven't seen in a long time. When you look at some of the other components, and I'll break those down, you see some gains, but not necessarily the same rate of gains that you're seeing in the food and energy side. So this is something to watch closely. And what's interesting is that you see the title of this slide says not all inflation is equal. So flexible inflation items are the most likely ones to come back down quicker than the sticky ones, like housing and medical care and education. What's funny is we're used to all the inflation being in education, medical care, and housing. And right now, housing, you're seeing some inflation, but not much in medical care and education. But where are you seeing it? Fuel, gas, electricity, and food. And that big jump in the yellow line are all the flexible components that are surging in price. So we do have the potential that some of these prices could come back down quicker, but it's probably not going to be until early 2023 before we really see things coming back. Although we are seeing the vehicles a little bit improvement there. So again, in summary on inflation, not coming down anytime soon, but likely to be a little bit lower by year end. That takes me to the Fed and interest rates, because to me, this slide explains why the markets have been so volatile this year. Look at the title of this chart here on the left. This says Fed Futures Contract, December 2022. And what this means is this is where the market expects how many rate hikes the Fed is going to do by year end. where do we expect short-term interest rates to be? And what you'll notice is, look at the end of December. The market was only pricing in 3 rate hikes by the end of the year. Fast forward to the end of the year, and the market is now, fast forward to April, the market now pricing in 9 rate hikes, or 8.6. That number is up to about 9.5 now. So that change in interest rate expectations over a short period of time is always going to lead to more volatility, because the market has to absolutely quickly reprice all of the assets to reflect a much higher interest rate environment. And this is why you see bonds having the worst 15-month period ever. We've never seen conservative assets do so poorly, and it's because of interest rates jumping up so fast. So I'm going to do one more slide, and then I'm going to turn it back over to Chad to go through some of the statistics around volatility and buying opportunities associated with this. But this is one chart I love to talk about, because it says stocks actually do well after the first rate hike. We're not seeing that right now, but that's kind of consistent with history, where the first 3 months after a rate hike, you really, on average, have not seen good stock market returns at all. But look at the next 6 months and the next 12 months after Fed rate hikes. There's been positive stock market returns 85 and 86% of the time. And sometimes, like over the next 12 months, you've seen an average stock S&P 500 gain of 10% or more. That is a number that surprises a lot of people, because you say, hey, the Fed raising rates, that has to be bad for the market. But you have to really look at the reason for the Fed raising rates: higher inflation and comfortable with where we are in the economic environment. So we don't necessarily have to have negative stocks. So Chad, I'm going to turn it back to you for a couple of fun slides.
All right, thanks, Robert. Appreciate that. So I wanted to kind of jump in here. We did have one question here. I'm going to actually answer this question coming out with regards to this slide. And the question is that we're sitting there watching these markets every single day. And City National Rochdale, we use a few other firms as well to get their research and their data. And when we look at that, we sit there and say, what's going on? And we want to be a little bit tactical to be able to say making changes. But if we're going, hey, should we have seen, this big market drop? And the answer is, it happens almost every year. So this is one of my favorite slides. I've been using this slide for over a decade. Basically going back over 42 years, the average inter-year decline in the stock market is about 14%. And we didn't actually plan this, but as of today, the S&P 500 is down about 14% year to date. So what we got to look at, this is an average sell-off. This is not the big recession that we're worried about. And what we want to look at is say, hey, should we have raised cash and then really could have made some major changes? I believe Robert would probably jump on and say there's a lot of things that could turn this market on a dime, which example being one, if all of a sudden the Russian-Ukraine war got rectified, or we found some semblance of an ending to it. If we did find, that, we're not going into a recession, because that seems to be the media's consensus, because if you say recession, more people watch. So when we look at this and kind of go back year by year, we can see that basically the average S&P return, going across here is pretty positive most years, about 75% of the time. There are some down years, but what we do see is in every year, there's typically a sell-off, which averages about 14%. So I like to bring this up because we believe very strongly in investing. We believe very strongly in long-term planning. And with that comes knowing that there is going to be a sell-off in the stock market. And when we see like this with the S&P 500, our S&P average return since 1980 is right near 10%. But to get that 10% average rate of return, we have to handle the fact that they do go through the ups and downs. And what we kind of find out with these downs is, why don't we go to cash? But we do actually position the portfolios for more conservative moves. So with Robert, he'll go through maybe some of the things that they do. They're looking at adding some commodities, adding some energy. We believe there's some different investments that can be still very good holds. But more importantly, what we're looking at is that when we see these type of downturns, we also see opportunities in there. And going back here again, going all the way back to 1980, what we find out is that after most all these 10 to 15% corrections, which we're in right now, that the 1 year and 2 year returns after that are typically very, very good. So what we look at as we kind of go through that is that, we don't believe in market timing. It doesn't work because you have to be right twice. Not only when do you get out, but then when do you get back in? You can say, oh, great, I missed that 12% down, but then you wait a year and you lost out on the fact that the portfolio actually went up 20%. So what we kind of say is, without looking at market timing, but more important, looking at the opportunities, what can we be invested in moving forward? And what City National Rochdale has said is a couple of areas that we look at is that, the industries, the areas we invest in are as important as whether you're invested. Did you want to add in on that, Robert?
Yeah, I'll just add a couple of things. I mean, Chad, I love what you said about, having to time the market twice if you're going in and out of positions. And then, again, tax effects too are another thing that can happen if you have an account that, 2021, to remember, this is one of the best years we've had stock market wise last year. So a lot of the positions, even with the downturn, are still at nice gains. So you pull the plug on some stocks, you realize taxes you might not want to pay. But I think in this environment, most importantly, why we don't want to go into cash or safe bonds is because what are the two biggest issues we see? Higher inflation and higher interest rates. And what happens to conservative investments when interest rates are high and inflation is high? You lose purchasing power, and traditional bonds have gotten just crushed because of those interest rate moves. So what you'll see, and Chad mentioned it, is the positions, the moves that we made in portfolios was to get those traditional bonds down to the lowest levels possible, pretty much across all accounts, if not eliminate them entirely. And, I have a nice slide. I'm going to skip the geopolitical risk slide because we've talked about it a bunch.
Perfect.
But there's a magical world of stocks called equity income that, despite the market being down this year, like Chad said, 14% through today, equity income, some of these stocks are up on the year. And this is what Chad just mentioned, some energy stocks, consumer staples. And this has been our, favorite place to be this year, as is clients have a much higher allocation to traditional dividend paying stocks than you might normally have. And what are these kind of companies? Well, Coca-Cola, Procter & Gamble, Pfizer, utility companies, again, some energy companies, defense contractors like Lockheed Martin. And, I like this line down here at the bottom: focus on quality, earnings, and revenue stability. That's why these companies have done very well. Because again, at Procter & Gamble, it's not an exciting company. I mean, they sell a lot of very basic consumer staples products, but it's an extremely strong brand with very stable revenues and a dividend payment that goes out consistently and continues to go up over the years. So if you're an investor looking right now, despite all the market craziness, you look at Procter & Gamble and say, why should Procter & Gamble stock be down 10% when nothing has fundamentally changed with their business? And I can expect to get a 3% dividend every year. So those are the type of companies that we love. So we've been really trying to get portfolios positioned to be in as many quality companies as possible. So one thing that we've done great this year is avoiding the speculative technology stocks. I mean, these are the stocks that everybody wanted to invest in because they're more fun, they're exciting. Many of these companies are the growth companies of the future. But you take a basket of companies like Shopify, Spotify, Roku, Square, Coinbase, Netflix, all these companies combined, we've seen their stock prices drop anywhere from 30 to 70% over the last, call it 6 to 9 months. And that's a shocking number. So avoiding those type of companies is exactly what we've done over the last 6 months. Because again, look at this chart here on the left. The valuation comparison between high quality dividend stocks like Procter & Gamble and Coca-Cola, and then just the overall market itself, S&P 500. S&P 500 is trading about 20 times earnings. The dividend stocks are trading down about 12 times earnings. Very cheap, and those hold up well in tough markets. But if I had to plot, where does Tesla and Airbnb and Uber and all of those companies, they'd be off the screen here because they were trading at 80, 90, 100 price earnings. And those are the ones that just fall down so fast at a time like this. So kind of summing it all together, our focus right now is on quality. We do think that the economy is not going into a recession, and that, despite the volatility right now, the best solution going forward is, stay invested in quality companies, but also stay defensive in those companies. Now's not the time to, put your foot down on the gas and try to speculate on, finding stocks that are going to double in value over the next 6 months. But it's not the time to put all the money under the mattress and get burned by 6% inflation a year. So Chad, I think I'll stop there and see if any more questions have come in, or if there's anything you want me to address before we sign off today.
Thank you. Well, thanks for putting this together, Robert. I really appreciate you putting the slides. It's great to hear from an outside and one of our trusted partners, with what you see. Again, if we have quite a few people here. If you do want to go down to the very bottom, there is a chat button. If you do have a question, please feel free to ask, and we'll kind of wait a few minutes here. I'll maybe ask a few questions to Robert as we're kind of going. So Robert, obviously you've been having a lot of conversations with different clients through this year. Have you noticed any? Oh, we lost it. There you go. Oh, are we going to have the fun thing where the kid runs through the back of your screen?
Not quite. We got something triggered the dog, so now he's been secured. So go forward with your question now.
Yeah, I think most people would love to see the dog anyway. So question is, how have these questions? Because I think what a lot of people feel like, and we deal with this every day, because it doesn't matter. I can tell you, going back to the last 10 years, almost every single meeting for 10 years straight, someone comes in with something they're very, very scared of. It could be, I could go back to 2018 with interest rates going up and the concerns about, the recession. Then I can go to what's going on with China. You could go into what's happened with Russia, with politics. It doesn't matter. It's been for a decade straight. It's always something that the media is throwing out as this is the next great thing. Have you felt it's been different this time, or has it been pretty similar?
No, I think right now, more than ever, what's being shown in the media and just the daily hits that you get with everything going on in the world, I think it's been worse as far as just driving up fear and panic, because just the world we live in media wise, it's not a political thing. It's like, it doesn't matter if you're liberal, conservative, most of these news organizations right now, are struggling to make money. And how do you make money? You drive views, and the extreme articles will drive the views. When markets like today, when the market's down, the headlines are Dow plunges they'll always tell you how many points it dropped. They won't say percentage, because the point sounds scarier than the percentage. Because you could say, I could write a headline, Dow corrects 1% total since Fed announcement, because it was up 3% yesterday, down 4% today. It's down 1% since the Fed makes the announcement. And no one's clicking on that article. No one cares. But that Dow plunges 1,200 points. That in big red letters across the screen, that's got everybody clicking on it, and that drives the worry. And especially now, I think the other thing, not just the media reports, but the inflation stuff is scary, because you're hearing it on the news, but then you see it, just absolutely see it in your day-to-day spending, because it stands out. You see it at the gas pump. Gas prices are obviously noticeably as high as they've been for years. You see it at the grocery store. Speaking of my dog, I went to get him his dog food, and $68 for a giant bag of dog food this morning. That stands out, because I can guarantee you that's the highest that's been in a long period of time. And we think about that as just this huge negative that's going to take everything down. And those stand out a lot more than some of those positive data points that we talked about. And one very interesting fact that I never see get reported right now. In fact, I just saw this article that said, millennials and young, TikTok users have more short-term debt than ever. And it was a totally misleading article, because what you see right now in consumer balance sheets, we have this disposable income still is positive. There's not been a time in the last 40 years that Americans have had more cash on hand than total outstanding debt. It's absolutely fascinating that we're in this position, but we really do. We have more cash in the bank than we have total debt. When you add up credit card debt, home debt, auto debt, it doesn't equal the amount of cash we have in the bank. So despite the higher numbers, and again, the negative GDP report was such a good example of this. We had a negative first quarter GDP, but it wasn't because consumers were spending less money. In fact, consumer spending actually jumped in the first quarter. Surprisingly, even we didn't think consumers were going to spend more money in Q1 than they did in Q4, and they did. So it shows that despite inflation being scary, number one headline, it actually hasn't impacted consumer spending yet.
Yeah. So kind of keeping with this chart, Robert, I know back in 2020, City National Rochdale raised a little bit of cash based on everything that was going on. Do you see any reason or time that the City National Rochdale would be looking to raise more cash? Or what would trigger that? Because when I look at this, I see a lot more green still than obviously red, and but the yellow is definitely growing, which is kind of more of that yield sign. So do you have any input on that?
Yeah, so I think a couple of things. One is whenever you see the U.S. economic outlook still in green, generally you're not calling for that major recession as a possibility. So it would have to be a really strong change in our economic outlook to get us to want to hold straight cash and be comfortable losing to inflation. For me, again, I think that, I'd be shocked if by the end of the year, stocks are not at a higher value than they are today. So if you feel that way, I'd much rather buy high quality companies that are paying me 3-4% dividends every year than kind of sit in cash and, not only potentially miss a market rebound, but also lose to inflation. So that what would change is if economic conditions deteriorate, likely inflation is going to be coming way down. I don't think you'll have both. I don't think you'll have prices stay this high with deterioration, and you'll likely have interest rates be higher. So I foresee more of a solution, Chad, is if we did get worried to go into more traditional bonds where we could at least get some decent interest than sit in cash.
Okay, thank you. Yeah, and I like to say, I think it's a great point. We kind of come back to that market timing. One of my favorite slides that I use in the class I teach on retirement planning is that 7 of the 10 best market days over the last 20 years came within 2 weeks of the 10 worst market days. So when we see days like today, which is one of the biggest sell-offs in the stock market in a couple of years, that usually 70% of the time that's led to in the next 2 weeks you see one of the best returns in the market. So it comes back to that market timing and kind of being invested as opposed to the day trading. I got a couple more questions for you. This is one I haven't had in a while, but kind of coming back on, maybe this is because Warren Buffett really railed on cryptocurrency here this last weekend, but it's what's our thinking on cryptocurrency? It's not very easy to understand what the real value is, especially given how much it takes how much energy it takes to mine it in that case. So you want to throw out your 2 cents on that? Because I think Warren Buffett pretty much and Charlie Munger were pretty adamant on their feelings.
Well, I mean, just look at the cryptocurrency charts today and you'll say, thank God we're not invested in that stuff, because, a couple of things we've learned with cryptocurrency is they're not hedges against inflation. Let's throw that out, because inflation is running as hot as it's ever run, and cryptocurrencies are almost down 50% from their high. So if anyone says I'm hedging against inflation by owning cryptocurrencies, let's throw that one out. Argument 2 for cryptocurrencies, let's also throw out, saying they're uncorrelated to financial markets. Not true. When the U.S. market is getting hit, it's usually cryptocurrencies are falling by a higher magnitude. Mm-hmm. Today, Bitcoin is down 9%, Ethereum's down 7%, U.S. market down 4%. So it's moving about double the rate of stocks. So I don't mind, people who say they have a little bit of fun investing in cryptocurrencies and, exploring the space, throwing a few dollars into it, but just it's speculative. It's be prepared to lose 80% of your money. It's not something we'll be doing in retirement portfolios or trying to speculate on it, but I don't think they're going away. I just don't think they're going to be something that is is going to be a core component of investment portfolios anytime soon.
And I think I love what you said there, and I preach this when we have our meetings, is that when we're dealing with the investments for retirement, we are investing for retirement. people want to speculate, there's nothing wrong with that. It's fun. Some people want to, and I don't want to compare cryptocurrency to gambling. I know gambling, but it's kind of that ability to try and make a lot of money fast, but you can also lose a lot of money fast. But that's what speculation is. When you're buying a stock, based on just hoping that somebody else is going to buy it at a higher rate, that's not our underlying investment philosophy. It's finding companies that have good cash flow, solid profits, leaders in their industry that we see continued growth with. And it might not be exciting because I'm going to probably guess you mentioned Procter & Gamble, and I bet you didn't get very many calls with people just begging you to buy Procter & Gamble over the last 3 years. But yeah, it's a solid company. All right, good, thank you. All right, here's a good one I got. I think COVID. COVID. I hate to say, is still not out of our lives, and it kind of seems like there's a possibility with rising rates of COVID again. And do you see possibly any new mandates? And if they keep rising, could that have any type of an impact on our economy and some of these outlooks?
Well, it's a fantastic question. In fact, what's shocking, Chad, is I've been getting almost no COVID questions.
I know.
It's like at the bottom of the list of concerns. It's just so funny because, it's not gone. We still have cases. I mean, I was actually on the phone with a client earlier today that they had COVID. Like they had it on the call saying, I'm at home recovering from COVID. And it didn't sound good. But at the end of the day, at the moment, it's not really affecting the economy much. In fact, it's been the opposite. The services industry is what's been booming over the last couple of months. Restaurants, bars, concerts, sporting events, leisure travel are kind of all at pandemic highs. So I do think this is a great question because if we did get to a situation where restrictions come back up again, you're going to see some damage to the economy again. And it depends on what it looks like. To me, I don't think, just from what I see, I don't think anyone's going to be reacting to cases, at least most of the governments right now. I think we're going to be reacting to hospitalizations and death rates. So I think there's a lot of political stress right now. I like, where we are in the Bay Area, I think is a bellwether because we were the most restricted, had some of the highest, mandates, mass mandates everywhere. And even San Francisco is trying to keep things open and try to get the services activity booming again, which I think has been somewhat successful so far. So I think, I don't know if this is right or wrong policy, but I think this is where they're going to go. It's not going to be cases that are going to have much of an effect. But if we do start seeing it, a deadlier new variant, hospitalization rates rise, that's a game changer. And that's hard to predict. So, I definitely would lower, when we look at this chart, if we get a new variant, throw me down into the mild recession category versus the slow growth category. But it's tough to project. Hope that answers that question.
Yeah. Got another one here is, do you, and I know kind of, you talked a little bit about supply chains being one of the issues that's kind of led to this inflation. On your guys' end, we've kind of always, I know it's been kind of kicking the can down a little bit. What's kind of the philosophy now for City National Rochdale with when some of these supply chains will be hopefully better?
Well, first it depends on the sector. Different sectors are getting hit differently. But again, it might be a while. We were all talking about end of this year for when supply chains were going to resolve themselves. But now you're probably pushing a lot of it into 2023. And again, it's just a lot of it's China. Some of it is Ukraine. But, some of it is companies have already adjusted a bit. You may have heard this statement. It used to be every company is trying for the just-in-time inventory. It was the way to keep costs down. Everyone had an efficient operation where you just have just-in-time inventory. Now it's the just-in-case inventory system, which is fill the warehouse with a year's worth of stuff so that no matter what happens, you're good. And companies have already started doing that. Like you're seeing Christmas preparations now for a lot of companies. And I've talked to a few executives at different companies. They're all dealing with supply chain issues. And I have a Microsoft executive I love talking to because he's involved in all of Microsoft's, China imports. He said if, the supply chain were a speedometer for him, it'd be in the yellow. Like it could get worse. It's not in the red right now, but it could also get better depending on how it plays out. But he said we're at least good for another 2-3 months before things really get bad. So, they're trying to pull out all the stops. But it's funny, like he mentioned, like, with a company that's importing computers, like apparently the sticker factory in China is shut down. And those stickers that go on your computer, you have to have the stickers on the computer or it can't get shipped out. So they're scrambling to find another sticker factory to literally just put a sticker on a computer to meet the regulations. And that's the kind of weird stuff that happens to really slow things down. But what Microsoft said they're doing is they've made up for it by just throwing everything on a plane instead of on a boat. So basically you're getting the stuff over at the same rate, but you're paying 2-3 times the cost to make it happen. So that's where you kind of have trade-offs across the board. For many companies, you're able to fly stuff in, but then you hit your costs. For other companies, you're just limited on your inventory. So it's anyone's guess. We really rely on our research team to think about this sector by sector. So you want to make sure you have companies that you're investing in that are less exposed. But again, it just all points to higher inflation for longer when you add it all together. That's why you're still talking about 6% year-end inflation.
Yep. Thank you on that. All right, I got a question for you. We got a little bit of time here, and I think this is a good one. Kind of coming back, I want to go back to 2018 because you and I talked quite a bit back in 2018. The stock market, basically in the fourth quarter of 2018, the stock market dropped about 20%. And this was a time when, there was so much concern. There was the concerns over rising interest rates. There was this worry with all the trade wars with China and others going to escalate. And the news was just horrible. And you came back with these charts and said, we're going all in now. We feel like the 20% sell-off. Are you seeing any similarities with that? Or is that, I don't want to draw that comparison. You and I haven't talked about that, but I know a lot of our conference calls have been very similar with, that time.
Well, I'll tell you for sure, 2018 December was, 2018 December was such a good parallel, not 100% because inflation was not an issue, but because it was the start of a rate hike cycle that had started and the Fed getting, investors getting spooked by Fed actions and a lot of geopolitical stress that was heated up. But at that time, our speedometers were almost all green during that one, where we said, hey, this is a complete overreaction, great buying opportunity. So it's a little different now in that we don't necessarily think the economy is in as good a shape as it was in December 2018. But at the same time, you do see a little overreaction to Fed policy. So I think this is a time to pick up quality companies that, haven't changed their earnings results very much. That's something we didn't talk about today, is that, there are some companies that are missing earnings. But, for every Amazon with a disappointing earnings report, there's been an Apple that's come out and said, despite all of our supply chain issues, we grew revenues and beat on the quarter. And Apple, to me, is a great example because Apple's not selling discount goods. They're selling high margin, expensive, many type of the stuff that Apple's selling is discretionary spending. And for Apple to have a good quarter, I think is a nice bellwether company. Visa as well. Visa is another one of those bellwether companies because it's just, how many swipes of the Visa card across the world are taking place, and a good earnings report is just consistent with more spending. So I do think we'll see some parallels to 2018, but maybe not as screaming of a buying opportunity as that was showing up as January 19th.
I just wanted to give some credit where credit was due on that one. That was a good call during a time when we had a lot of the very similar phone calls with rising interest rates. Instead of it was significant China. That was the scary time with China, especially. We have time for if there's anybody who wants to ask another question. Otherwise, I'm going to go with one more. It's kind of you mentioned a lot, kind of talking about the quality dividend stocks. That has been definitely a wonderful call that you guys have done. And one of the main reasons, when we're working with you, we're talking a lot about those dividend stocks, those value stocks. When does it get to a point? Because we are seeing like companies like Amazon, which I think was almost the going into this year, I think was picked by, it seemed like every company, every market maker out there to be the #1 company for the year. So when do we get to a point, or is there a point where if CNR Rochdale says, hey, you know what? Some of these growth stocks have just gotten crushed. We want to start picking those up as well.
Yeah, it's a good question. I'm thinking about that one myself too. It's like you see some of these stocks really getting beaten up, But today shows you there's more to go. I mean, today the growth stocks just took it on the chin again. And I think, until we really see some clarity on where things are going, again, it's more of a focus toward the quality companies in our mind than the growth stocks. So I do think you might get to that point eventually, but NASDAQ is down, close to 25% on the year. If that's another 10% down, if we're looking at a NASDAQ down 35, I'm not on the research team, but I wouldn't be surprised if we had a call to boost some of those stocks, especially the ones that are making profit, that are part of that. But, one thing to add, Chad, though, for dividend stock investors right now is we are trying to make some tweaks to those portfolios, because some of these dividend stocks have done so well. These companies' dividend rates, that when we bought the stock, it might have been averaging a 4% annual dividend. And now that dividend rate might be under 2% because the stock value has gone up so much. So one thing we're looking at is, can we get into more dividend stocks that are paying higher yields, that maybe haven't been going up as much, but check the boxes for the stocks we're looking at. So you may see us, take some action to get some different dividend stocks in there. And then also the final point I'll make is it's a good opportunity for some tax management too. So in volatile markets, what we're doing for clients that have taxable accounts is, selling some positions that may be down, using that as an opportunity to capture tax benefits, and using the proceeds to buy other stocks that are likely to go up similar to the ones that we sold. So you get to capture a tax benefit without losing any performance if things recover. So that's called active tax loss harvesting. And it's one of the most important things we can do in a volatile market like this to keep portfolios in line and capture tax benefits.
All right. Robert, thank you so much for your time today. It's always a pleasure. I really enjoy all of our conversations we have with clients. One of the things, to all the people listening, thank you for taking the time out of your day. If you do have questions, more questions, you want to ask them more personal, feel free to reach out to our office, talk to one of your advisors. I'm happy to jump on a phone call if there are. I know it's when we watch the media, it's hard to kind of say that it's not scary. One of my favorite calls is I got up, I watched the news for about an hour and came into work going, wow, that seems horrible. And then went through and did a full couple of meetings with Robert and going through these slides and talking about really long-term investing. And it's just going, wow, this is a great time to invest. And it really kind of comes from the information you're getting. So our goal is to really give you hopefully some unbiased fiduciary advice that says, here's kind of really where we're at. Yeah, inflation is bad all by itself. But in the grand scheme of everything is, how do we invest and how do we protect your guys' retirements throughout, even regardless of inflation? So feel free to call us if you have any questions. We might have the advisors follow up with you if you did ask a question, just make sure it got answered. And if you're also, just so you know, if you're in Bend here tomorrow, I know maybe a little bit rainy, but we are having a shred event. So if you have some shredding you need to take care of, or you just want to come by and have a drink and some charcuterie board, feel free to join us. I wish Robert could make it up here, but I know he's got a little bit of a long drive.
Next time, Chad, I'll take you up. You got to get it on my calendar. I'll bring all my shredding from California here.
Perfect. All right, everyone. Everybody. Thank you very much.